Hi, it's Mrs. Simonson, and we're going to continue on with section 6.2. So how do we actually record in this new thing called the general journal? The definition for general journal is it's an all-purpose journal where you can record any business transaction. We get way more specialized as we get more advanced in accounting. We'll have sales journal, a purchases journal, a cash payments journal, and cash receipts journal. Everything can go in the general journal. It's just the other journals become easier because they have specific columns for things. And we'll talk about that more as we go. If we look at this journal page here, you can see that it has two amount columns. Okay, so an amount column here for debits and credits. There's no commas written here. You can kind of see that these vertical lines separate the cents from the dollars, and the thousands marker is right here. It's a little bit different than maybe what you're used to. So debits on the left, credits on the right. There's 6 steps to making a general journal entry. The first step is to write the date. The year always goes at the very top of the page, and we kind of waste a line there. And then we have the month and the day. We don't have to do these two again, year and month, until we have a new month or a new page. The second step is to write the debited account name. So whatever that might be, cash or whatever. The third step is what was the debit amount. The fourth step is the name of the account that was credited and the credited amount. And then the 6th step is the explanation. And generally this points back to whatever our source document was. So check number 110 or invoice number 223, whatever that might be. So that if we had a question, we can go find that paperwork somewhere. So basically we're just going to jump through some transactions again, and they kind of talk about, this is how we used to do our business transaction. We're no longer using T accounts. You can if you want to. It's helpful to use T accounts we're talking about here, but after you do it long enough, it's not a big tool anymore. I'm hard pressed to write a T account anymore just because I've done so many transactions. So let's just look at some of these source documents and how they would go into the general journal. So we have our first transaction of $25,000 we're taking it from personal savings. We're going to put it in this new business. There's not really a source document for it, so we make a memorandum. And the owner says, I've contributed $25,000 to this new business. Okay, so we're going to journalize that. We're going to do that just like we always have. Cash is a debit, capital is the credit. Here's how it looked in the T account. And then if we look at the transaction, If we look at the transaction here in the image, we have our date. Cash is the debit account, and here's the debit amount. Krista Vargas Capital, that's not right, is a credit, and our source document. Notice here we also have a page number. We number the pages in the general journal sequentially. Awesome, that worked. Wasn't sure if that was so the page numbers are always up here at the top right, and they come into play later. So it's important that you number the pages. Transaction 2, we took 2 telephones from our house and put them into the business. So our office equipment is going to go up as an asset, and our capital is also going to go up as an asset. And so here's how that would look. We've done that transaction before, and that was another memorandum. Transaction 3, we wrote a check. So here's our check stub. It's a little bit different to get used to these. This is kind of an old-fashioned way of doing checks. We wrote the check for $3,000 on October 4th. Dates become very important. We wrote it to Info Systems Inc., and we bought a computer. So this is our balance in our current cash account, and we wrote this check for $3,000, so we now have $22,000, which is different from the general journal, but we're going to eventually talk about working with cash. So computer equipment, the debit is going up. That's the debit, and we wrote the check. So cash is going down. So if we look at our journal entry, notice we don't have the month and the year because we're just moving down through our transactions. Source document being check 101. We bought a used truck on account. Okay, so here's our first invoice. Remember, we're Zip Delivery Service, so we are buying this. If it were our invoice, we'd have our name up here. A truck, and terms are we're paying in installments, so we're paying on account. If we bought it with cash, we'd have a check stub instead of an invoice. So our asset delivery equipment is going to go up. That's the debit. And accounts payable is going to go up, and that is our credit. And we write the invoice number listed there. Okay, I'm just going to skip through to a couple of these. Let's see. We wrote a check, and we put $350 down on our truck. So we're starting to pay our truck off a little bit. So here cash is going down. It's the credit. Accounts payable is also going down. It's the debit. One thing I forgot to mention is you notice here in these journal entries, the debit is always written first because it's on the left side. Things are indented a little bit here. Cash is indented. It's the credit. And then you'll notice even the source document is indented a little bit there. Okay. We deposited a check for $200 for a company paying us on account, something that we sold them. So it's a receipt. Okay, so receipt means cash is coming in, cash is going up. That's the debit. They no longer owe us as much money. Accounts receivable is going down. That is the credit. So here's what that transaction looks like. Okay, let's hit a couple more big ones. All right, here's a revenue transaction. We provided delivery services for Sims Corporation. A check was received for full payment, so we had a receipt. It was a cash revenue transaction. Cash is going to go up. That's the debit. Revenue is going to go up, and that is the credit. Here's how that would look in the journal. Paying our rent, we're going to write a check for that. Notice it's in the 4 line here. So rent expense is going to be the debit. It's going to go up, and cash is going to be the credit. And it is going to go down, and it would look something like that. All right. Here we provided delivery service, so this is revenue. We're talking about how we make money, and we build them. So kind of how some people were getting stumped in Chapter 5 about billing. So they didn't pay us cash. So this is our invoice. We sold them delivery services, so it's our revenue transaction, but they didn't pay right away. So it's an accounts receivable. So this transaction would look like this. Accounts receivable is the debit. It's going up. Revenue is the credit. It is going up as well, and it's our sales invoice number 1. It's our first revenue transaction. The next 2 look like expenses. So here we did some painting in our office. We wrote a check for that, so cash is going down, and we're going to use a maintenance expense account. That's going to be our debit for $600. Paying rent, paying advertising, they all look the same. And then the final one here was that she withdrew money, $500 cash. We wrote a check, and our transaction here would look, withdrawals the debit, cash is the credit. And then the final thing is when you make a correction or a correcting entry, you never really erase things, but in Excel, we're just going to redo them. And we'll talk about that a little bit later.